Hi guys, hope you're well. My name is Alexander and this is a new episode of True Fair Value. And today we'll determine the true fair value of BBBY, Bad Bath and Beyond. That's right, yeah, that's the meme stock. We saw a lot of volatility in the stock in the last few quarters, few months, and even the last few days right after they published their quarterly financial report. And the headline said results below expectations, sales weaker in major states, Florida, Texas, and California. Well, guys, this is frightening. But let's take a look deeper. Maybe we will find some value in this stock. Let's go. First, we start from the top line. Remember, what is the top line? Is the revenues, the net sales. It's how much the company made by selling its goods. It's minus 27%. It's going down. There may be two reasons for that. Either the company is closing down the store so people are unable to buy the product, or the people don't like the product and they just don't go to the stores to buy it. Well, let's take a look. The company said that it closed down 200 locations, 200 stores. Well, this is a partial explanation. Let's look at the profitability. How much money are they making by selling the goods? The gross profit went down 39%. That's even more than the sales. This is a bad sign. That means that something is affecting the expenses. Something is making their costs go up. Well, this is not a surprise. We hear from every company that the main problem is the wage inflation, the supply chain constraints, the freight costs, the truck drivers that are charging more, and so on. This is something that's going on throughout the industry. In all the industries in the US, we see the same thing. So this is not really bad. This will fade away with time. Let's look at the operating margins. Minus 84%. It's a negative number. They have a operating loss. Right, let's go straight to the bottom line. If we see these numbers in the profitability, in the operating margins, then we don't expect anything good in the bottom line, in the net income. And we don't see anything positive there. We also see a negative number of minus $73 million. That's a loss. That's bad. So now we need to find out, what is the management going to do with it? Obviously, it's the mistake of the management. I mean, this is a company just operating the stores and selling their own brands in their stores. This is not high technology. This is not rocket science. It's just operating stores and selling stuff. I think any one of you, or even me, can basically do this job. We all know what it is. You just attract the customers, you sell them stuff, you make money, you make a profit, you share the profits with your shareholders. Let's see what these guys are doing. So we need to find out the reasons. Why is it happening? Why is the company losing money? And where do we get the answers? Correct. From the CEO and CFO, we pay these guys to run the business. They should know the answers. If they're doing a bad job, we should fire them. We have the right to fire them as shareholders because it's our company, if we are the shareholders. But now we're looking at this company from a shareholder point of view because we need to determine whether it's a good investment or not. So we spoke to them. The CEO's name is Mark. And you know what the first thing that Mark told us? I even have this written down. He says that there is significant progress on long-term strategy. After that line, I stopped listening to this guy. He's bullshitting. Look at the numbers. You have negative operating profit. You have negative net income. What are you talking about? You are operating stores, not making any money. And this is significant progress on long-term strategy. Guy, you're a bullshitter. Don't waste your time listening to those guys. Because if you do, you will either believe them and you'll make a lot of mistakes, or you won't believe them and you'll just waste a lot of time listening to them. Time is something that you can never get back. So don't do this. So let's go straight to the CFO. Maybe this guy is more realistic. His name is Gustavo. And he is more specific, at least in terms of the numbers. And he said, well, we do see some growth. And we see growth in the digital sales. They now make up 34% of total sales. This is a good sign because the company doesn't really need the stores in order to sell via digital channels. They just need to attract the customers and to deliver. and they use third-party services to deliver their goods. They're not doing it themselves, actually. So they will become not on Amazon, but a company that doesn't really need the physical stores to sell. You just need the logistics centers, the warehouses, and a good delivery service. Plus, Gustavo said, the loss that you see, well, 77 million of those is a one-off. We spend this on restructuring, on an IT system, on some transformation initiatives. We won't do it again. So we can adjust for that. If we won't see these expenses recurring, if we take them away from this quarter, that means they made money. They made a profit. They made earnings per share of 4 cents versus negative 72 cents. So this is good. The company's it is capable of making money. It's not burning cash. Speaking of cash, how much do they have? Because remember, these are just stores. People come with cash, with their credit cards, and they just buy it on the spot. They pay the money. The company should be generating a lot of cash. It does. It generated $75 million of operating cash flow in the quarter. Yeah, they spent 77 on this one-off restructuring transformation initiative, whatever, the IT system, but they have some left. How much do they have accumulated on their accounts? Well, if we look at their own money, it's $1.1 billion. They have a line of credit of 1 billion more, but I don't count that. I don't like a company which is not growing, which is not expanding, that is using the credit line. That's a bad sign. So it's a good thing they don't use it. And actually, Gustavo is not even talking about it. So I like this guy more than the CEO, actually. So if they have 1.5 billion and they're closing down the stores, remember they closed down 200 stores, they should give the money back to the shareholders if they don't reinvest it in the business. Are they doing it? Actually, they are. They repurchased $100 million worth of shares in the quarter. That's a good sign. Whenever a company sees that it's not going to grow, that it doesn't need the money to grow, it should give it back to the shareholders. And they are doing just that. So this is a good sign for us. So given all these numbers, we need to make our own view of what's going to happen. Well, November is going to be a good month. Remember, the next quarter is 3 months: September, October, November. November will be the best because we have Thanksgiving, we have the Black Friday, the sales will be high. We don't think the company will grow. We think at least it's not going to fall. So if it sells around $2 billion per quarter, it's going to have the same sales this quarter. At least we think so. So if we look at 1 year ahead, around 8.1, $8.2 billion is what we can expect in terms of sales. Let's look at the gross margin. We don't think it's going to stay high. We think the company will face a lot of constraints on the supply side, on the cost, on the wage inflation. And we think that the gross margin will total 34, 33%. So when we implement this, we see that the money left, the profit, basically will be around $0.9 per share. So we go straight to the per share. We don't count. We can skip the lines like the overall profit and divide it by the number of shares. We count it straight away. So the company said, Gustavo said, they're going to return 100 million more to the shareholders next quarter. This is good. We have to count that in. So we have to count the rate at which the company is returning the money to the shareholders, see how much future profits will be returned, and then we just implement these numbers into our model to determine the true fair value. Before we do that, remember, we need to categorize the company. We need to assign a tier to this company. Remember, the first tier is the best companies that are growing, that have a positive cash flow, that are returning money to the shareholders via dividends, because dividends are sticky. It's really hard not to lower or to stop paying the dividends. They have to continue paying them or even raising them. And this is what's going on at the first tier group. The companies from the first tier, they are all increasing their dividends every year, at least every year. The second tier are the companies who are making money, who are paying dividends, not increasing them all the time. Sometimes they are keeping them flat. Sometimes even they're decreasing them, but the companies with a stable cash flow, which are at least not falling, at least they have a positive revenue, positive net sales every other quarter or every other year. The third tier are the companies like this one that are not stable in terms of their sales. We see sales going down 27%. That's a lot. We see that the company is losing money if we don't do the adjustments. This is also not a good sign. So this is the third tier. The fourth tier is the companies who are losing money and not paying out anything. So we assign the third tier. That means that in order to justify our investment, we need to make at least 6.5 or 650 basis points or 6.5 percentage points on top of the risk-free rate. For the risk-free rate, we use the 10-year treasury, which is now 153. So we should make at least 8.03% return during the next 10 years to justify our investment. Let's see what our numbers show us. All we do is the numbers that we just figured out, we just input them in the model. And we count how much profit will we get as shareholders if we buy the stock today. We did this for you. You can check our calculations, but we did this for you. So our numbers show that if we put our projections, the ones we discussed in the model, we'll get a total profit of 22.60 actually, $22.60 during the next 10 years. That gives us 2.26 per year if we don't use any compounding. That translates into an annual yield of 14.9%. Remember, how much should we make for this investment to justify itself in order to break even, basically? 8.03. And giving our projections, and our projections are not optimistic. Actually, we're looking more or less flat on the business in the next 10 years. Even if the business will not grow, if it stays it is this year, if it doesn't generate more profit every year, then we'll make 14.9% per annum. That means that this stock is a strong buy. This is why we like it. We will adjust our model once we get any new numbers, once we see that the numbers are better, if the November sales are higher than we expect, if the, like he called it, the progress and the long-term strategy, if that somehow starts to work, if we get better numbers next quarter, next year, then we'll implement new numbers into our model. But even with these numbers, this company is a strong buy. Never invest in a company if you don't know the true fair value. If you did not figure out the numbers, if you did not put them in your model and you do not see the yield that you are generating by buying this stock on a 10-year horizon. If you need our help, drop me a message. We'll let you know the true fair value of any stock in your portfolio, of any stock that you're thinking of buying.